Welcome back to Market Matters. This is episode 2 of our free stock market course on technical analysis. In our last video, we introduced you to technical analysis. Today, we'll dig deeper and uncover the core assumptions of technical analysis, and also learn about the OHLC, Open, High, Low, Close data that powers every stock chart. One of the biggest advantages of technical analysis is its versatility. As long as there's price and volume data, you can apply TA to any asset class: stocks, commodities, currencies, even bonds. Think of it like driving a car. Once you know how to drive, it doesn't matter whether it's a Maruti Swift or a Mahindra XUV. The basics are the same. Similarly, once you learn TA, you can apply the same tools like RSI, MACD, moving averages, across equities, gold, crude oil, or even the US dollar. Now, unlike fundamental analysis, technical analysis doesn't care about a company's balance sheet or earnings. What matters here is price action, the story told by historical data. But TA rests on 4 key assumptions. Let's break them down. 1. Markets discount everything. All news, events, and even insider activity eventually show up in price. If something's about to happen, the price usually hints at it first. 2. The how matters more than the why. Technical traders don't waste time asking why the price moved. What matters is how it moved. The how gives trading opportunities. 3. Price moves in trends. Big moves in the market are not random. They happen in trends. Once a trend sets in, prices usually continue in that direction for a while. 4. History repeats itself. Why? Because human behavior doesn't change. Greed and fear drive buying and selling the same way they always have. That's why chart patterns tend to repeat. Now, let's talk about the building blocks of price charts. OHLC: Open, High, Low, and Close. Open price: the very first trade of the day. High price: the maximum price the stock hit during the day. Low price: the minimum price the stock touched. Close price: the last traded price when the market shuts. Among these, the close price is the most important. It reflects the market's final verdict for the day and acts as a reference for the next session. If the stock closes above the open, it's usually considered a strong day. If it closes lower, sentiment is weak. So to recap, TA works across any asset with time series data. It's built on 4 key assumptions. Markets discount everything. The how matters more than the why. Prices move in trends. And history repeats itself. And the daily action is best summarized with OHLC data, which forms the backbone of all charts. In our upcoming episodes, we'll see how these basics transform into powerful trading strategies. If you found this helpful, make sure to hit like, share, and subscribe to Market Matters for more episodes in this free stock market course. Next up, we'll dive deeper into understanding candlestick charts and how traders use them to spot opportunities. Stay tuned!